let's take a look at problem 6.5 for homework and follow along with me as I work through this problem. The construction and financing phase of a special assessment project accounted for in a capital projects fund, and the debt service phase is accounted for in the debt service fund. Upon annexing a recently developed subdivision, a government undertakes to extend sewer lines to the area. The estimated cost is $10 million. The project is to be funded with $8.5 million in special assessment bonds and a $1 million reimbursement grant from the state. The balance is to be paid by the government out of its general fund. Property owners are to be assessed an amount sufficient to pay both principal and interest on the debt. During the year, the government engages in the following transactions, all of which would be recorded in the Capital Projects Fund. So we will take a look at the transactions that we will then provide journal entries for. It recorded the Capital Projects Fund budget. It estimated that it would earn $0.20 million in interest on the temporary investment of bond proceeds, an amount that will reduce the required transfer from the general fund. It estimated that bond issue costs would be $0.18 million. So let's just take a look at how we would report that budgeted journal entry. We would start with a debit of estimated other financing sources bond proceeds of $8.5 million, because that's what we're anticipating for the bond. The estimated revenues for the state grant coming in was at $1 million. We anticipate our interest earnings to be $0.2 million. And then remember, it said the difference is going to need to come from the general fund. So we'll show the $0.48 million coming from the general fund. Now we know that our construction costs are $10 million, and it gave us the information that our bond issue costs are going to be $0.18 million. So this is really recording all of the anticipated expenditures and revenues for this project. The next one let's look at number 2, shows it issued $8.5 million in bonds at a premium of $0.30 million and incurred $0.18 million in issue costs. The premium net of issue cost is transferred to the newly established debt service fund. So we'll know that our bond issue costs are $0.18. We know that the bond premium came in at $0.3 million. Our other financing sources, bond proceeds of $8.5 million, and then we end up with cash of $8.62 million. Now the net, the amount of the premium minus the bond issue cost, is what will be transferred over to the debt service fund. So we've got other financing uses, non-reciprocal transfer of $0.12 million, a credit due to debt service fund of $0.12 million. Next, we've got, it received the $1 million grant from the state, recognizing it is deferred revenue until it incurs at least $1 million in construction cost. So we will go in here and show our cash of $1 million and credit a deferred revenue state grant. The next thing we'll look at is it invested $7.62 million in short-term securities. So we'll show that investment as a debit, and we'll show a credit to cash of $7.62 million. Then as we go back and look at number 5, it issued purchase orders and signed construction contracts for $9.2 million. So in that case, what we'll do is show our encumbrances, a budgetary entry, and credit a reserve for encumbrances of $9.2 million. Next, with number 6, we will show it sold $5 million of its investments for $5.14 million. The excess of selling price over cost represents interest earned. By year-end, the investments still on hand had increased in value by $0.06 million, an amount also attributable to interest earned. Again, if we look at this, we will show that our investments were at $5 million. We sold it. The interest earned was 0.14, gives us our cash of 5.14. And then at the end of the year, we did increase our investment market share by 0.06 million, and we would treat that as investment interest revenue, as you can see right there. Next, we've got it received invoices totaling $5.7 million. As permitted by its agreement with its prime contractor, it retained and recorded as a payable $0.4 million pending satisfactory completion of the project. It paid the balance of $5.3 million. Again, we will show the expenditures of $5.7 million. We will show what we actually paid of the cash of $5.3, and the retainage payable that we are going to hold on until the project is done of $0.4 due to contractor. We'll also, when we create this journal entry, do the budgetary entry to show that we actually can reverse the encumbrances and encumbrances of that which was billed. Next, it transferred $0.12 million to the debt service fund. We can then show due to the debt service fund $0.12 million, and we can credit cash of $0.12 million. Now that we have received some billings, we'll be able to create some other journal entries, such as the deferred grant. It updated its accounts but did not close them, inasmuch as the project is not completed and its budget is for the entire project, not for a single period. And so we would want to show that that deferred grant was debited, so we can now report it as a revenue grant. Now, to create the statement of revenues, expenditures, and changes in fund balance, we budgeted for the grant from the state of $1 million. It actually came in at $1 million. We budgeted our interest, and actually that interest did come in at $0.2 million, with total revenues of $1.2 million. Our bond issue costs were budgeted at $0.18 million and were actually $0.18 million. The construction costs were budgeted at $10 million, but as of date, our expenditures have been $5.7 million. So as you see here, the difference between the revenues from the expenditures at a minus $8.98 million budgeted and a minus $4.68 million actual. Then we will report our other financing sources and uses. We received bonds of 8.5. Budgeted, actually, we brought in 8.8 because of the premium. Then the debt service fund was a use that we transferred over. And then we also will show the money we brought in from the general fund. So as you can see here, the budgeted, of course, should be zeroed, but we're actually have an excess of revenues over financing expenditures because we haven't completed the project yet. And then as we move on to the next balance sheet, here you'll just see a list of, if we take all of our debits and all of our credits, you'll see cash ends up with $1.72 million. Our investments, again, take the investment, the journal entries we've provided, and you would end up with 2.62 in investments. We would have an interest receivable of $0.06 million. What is still due the contractor, and then our fund balance. Now again, you can take these journal entries and go through them, add, subtract, and notice that this is in fact where the numbers will come from.